Sanjay Koul joining us this morning from Timken India, one of the top gainers of 2019, getting a sense from him of demand going forward as well. Sanjay, thanks for joining us. Now, the street has rewarded the share irrespective of what we've seen in the auto industry otherwise, and as well as the sluggishness in infra and activity. Tell us, however, the rationale for remaining invested. What are some of the avenues that you're identifying to offset some of those slowdown concerns?
So good morning. Thanks. Every time the emission norms change, there is a dip in the market. Only this time around, the commercial vehicle market took the dip before the emission norms change took place, as they will take place on 1st of April. So if you go back into history, it always happened when the norms change. And this time, because of the fact that axle load changes and rest of the liquidity issues did play a role, and we had this demand vanishing. So while the demand took an early dip, I am sure that the rebound is also going to be a little bit early because of the fact that the inventory corrections have taken place in the market. Liquidity is going to be sorted out, and I'm sure that the man on the road is going to be able to borrow. The traditional LFOs and small truck owners are able to go and borrow money. So I think while the inventory correction has taken place, there is going to be a little bit of a pre-buy. So January, Feb should be okay. And then as the liquidity eases out and there is a freight movement taking place, we might be surprised pleasantly that the market comes back a little bit early. But of course, we had a great run of 4 years, and then this dip was expected. It came a little bit sooner, which is unfortunate. But I'm sure that the inherent market conditions, which is demand driven out of India itself, should be strong enough, and with a little bit of the help from the policy makers, scrapping the vehicle after 50 years, etc., pushing the liquidity, we might get a little bit better 2020 post-September.
Large part of your business also comes from the power transmission space, if our understanding is right. That's where some would say there is a challenge because power sector is in a doldrum. Utilities are not expanding, private guys are not expanding, state discoms don't have money. The supply chain is in a problem, the entire power sector. So what does that mean for your power transmission business?
So basically, Timken serves fragmented markets. Everything which is moving, everything which has wheels, or everything which is moving on stationary equipment needs a bearing. As we have this strategy of serving fragmented markets, be it on-road, off-road, off-highway, rails, trains, power, coal, mining, we serve these diversified fragmented market. While we see that there is a dip certainly in the coal side of it, that is power coming out of the pulverizers which is burning the coal, we see a very strong offtake in terms of the wind market. So wind has been a nice 2019 surprise for everybody in the market, which wind has taken off. Not only for the domestic consumption, a lot of gearbox manufacturers are exporting gearboxes out of India to other markets, including China. So while you're right, the power sector, especially in the coal burning area, the pulverizer market has gone down, but the wind has equally gone up. So it has washed out what has gone down by getting the wind piece up.
Overall, tell me, what's your product pie going to be like, or product mix going to be like? Would you say that there will be a higher contribution of power perhaps, or would it be largely auto ancillary, which will be the largest pie of your revenues going forward too?
I think that this is a very important question, especially for companies which has to make sure that the strategies are right. In 2020, in India, I would say that commercial vehicles would not be great. They would start coming up slowly and steadily. Rail in India would be pretty much good. And when I say rail, rail has to be divided into locomotives, freight, and passenger. In passenger, it has to be further divided into mass rapid transportation, which are the metros in India. So you can see that rail systems in India, whether it is the metros of India or the passenger vehicles which are being modernized and they are being made high speed and high safe. So this market would be pretty okay. Off highway, as the infrastructure push from the government takes place, off highway market should be okay, and we have seen December was pretty much a decent month as far as the excavators and the backhoes are concerned in India. So that market should be okay. The power coming out of thermal should not be great, but at the same time wind would be pretty much good. We have seen that the commodity price is going up, so I'm expecting steel won't be that bad, and with steel the MRO business generally remains okay. So on a whole, 2020 would be a mixed bag, while the commercial vehicles, which has a huge traction, it consumes a lot of small bearings, that might not be great, but the other areas which consume large size bearings and large value bearings will be certainly okay.
How much of your business is coming from the non-MSE and SME sector? Because the problem is with the MSE and SME sector, some don't have money, some don't have capital, some don't have ability. How would you classify a business, not industry-wise, but category-wise in terms of your clienteles and the size of the clientele?
From the small sector, our business is very small, very, very small. Though, every customer is important and we serve all the fragmented market. But generally, we are, if you talk about the MRO, we are generally serving the large area of mining, power, cement, metal. These are our large markets. So we are not into supplying into, say, for example, if I can take the example of Manesar belt. So we hardly supply any bearings to that area. These are the small scale industry which consume bearings on their machine tools, etc., etc. We are generally playing the industrial market of the large space and not the small space, though we want to serve all the markets. But given the fact that we don't supply them and that market is struggling, so that kind of gives us a smile in the short term.
Sure. Let's talk about exports as well. Expected exports are about 50% of sales the next few years. Talk to us a little bit about the facilities, the kind of business they're clocking in, how you see exports panning out.
Export has been an important part of our strategy. We've been exporting for many years, both in terms of heavy truck, off-highway and railway systems. We continue exporting these to different markets around the globe. And certainly there are markets where the markets are going down, and there are some global markets which are going up. So for example, if we see the rail market globally currently is not that bad, but while you see the heavy truck market globally is a little bit down. But we keep on serving all the markets. We serve from here China, Africa, America, Europe, even Russia. So, one market is down, one market is up. Given the cost quality delivery of Timken in India, we've been able to serve these different export markets. But, it always, when the global markets are struggling themselves, it is a challenge for emerging markets to supply those global markets, especially when the supply chains have not really changed a lot in last decade or so. But I would still say that the exports would remain okay for us, if not great.
Help us understand, what exactly is going to be a margin catalyst for you going forward, and what is it that we can actually expect by way of earnings going forward? Are we going to finally see a revival come in, or at best you'll be able to maintain the margin levels that you did in the previous year?
For margins, you need two aspects. One is the cost and another is the price. I don't think the prices are going to go up. So we've been able to get whatever prices we got in last 18 odd months. So those prices is what we got, and I don't think there is going to be any price uptake. As far as the cost is concerned, which is again going to help you on your margins, is that we are creating, and we have created very robust supply chain. Say, for example, our Jamshedpur plant can go from melt to finished bearing within a radius of 20 kilometers. So that is the power of supply chain, which eventually cuts the waste. So we are relentlessly working on cutting waste, and especially when there are downturns, we make sure that we don't waste a downturn. We make sure that we tighten our belts. So we continuously work on our cost front so that we optimize and we generate less and less waste. And on the price front, I think there is going to be a stagnant pricing. I don't think there would be any great pricing coming our way. So in short, I think that our endeavor is to make sure that we will keep on generating value as much as possible, and Timken in India is a leader in supply chaining the bearing piece of it. So I am not unduly worried on the margin side.
Thanks for joining us then this morning and talking us through the latest there.